Hello everyone. In this video, we'll look at a key concept that could actually turn even a good strategy into a bad strategy. Let us assume that you have a good trading plan and a good strategy. Let's say you are planning to buy some option at 100 rupees and you are planning to sell it at 105 rupees. Planned profit is plus 5. And when stop loss is going to get hit, your max loss is about minus 2 rupees. Let us assume that this strategy wins 50% of the time. That is 50% of the time you get a profit of plus 5 and 50% of the time you get a loss of minus 2. The strategy has positive expectancy. That is, if you run it for a long period of time, you're going to end up with profits. But in reality, what happens is that when you plan to buy the option at 100, you won't get 100. You are likely to get something above 100. Typically, let's say there is a 1 rupee slippage, you get 101. This difference between the planned buying price and the actual executed price is called slippage. Let's say the strategy goes well in your direction and it moves towards your planned sell price of 105. When you sell it, you are going to get a lower price than your sell price most of the time. Many people might argue that slippage works both ways. You might even get 106, but that's not the case. Most of the time, you will actually get a lower price than your sell price, sold at 104 minus 1 slippage. So you actually plan the trade for a 5 rupees profit, but you don't get 5 rupees. You only end up getting 3 rupees. 104 minus 101, 3 rupees. Now let's say the trade is going against you. You bought at 101. Your stop was supposed to be at 98, but the stop got triggered. You didn't get 98, you got 97. You sold 1 rupee lower. The actual loss is minus 4. You were supposed to get minus 2 loss, but you got minus 4 loss. Let's say you took two trades in a day, one ended in profit, one ended in loss. You were supposed to get plus 5 minus 2, which is plus 3, but you actually got plus 3 and minus 4, which is minus 1 net loss. Your order goes through different layers throughout the day. Like whenever you place that buy order and by the time it gets executed, it passes through these different layers. Let us go one by one. Number one is screen data delay. For example, you see the market depth in Zerodha, right? The prices that you see are actually not the real-time prices. They themselves are delayed because the exchange has to give the price data to your broker and the broker has to actually display it in their website and it has to reach you through the internet service provider. So there is a latency when these prices reaches you. It's probably going to be a few milliseconds, but it matters when it comes to shorter term trading. So there is a screen data delay, firstly. Second, there is a human reaction time. In case you're not using algos, you are placing orders manually. By the time you place your order, this 136 could actually become 140, heavy slippage. So that is human reaction time. Third is broker platform plus risk check. When you place the order, your broker will also perform some risk checks, basically check whether you have capital, whether you have margin and all that. So there could be some time lost. Then there is algo platform relay. In case you are not placing orders by yourself, you're using some algo platform. The algo platform connects with the API of the broker and then it has to place orders. There could be delays with respect to algo platform. The servers of the algo platform could be down. So we don't know. I have typically observed somewhere between 1 to 15 seconds delay when I have used different algo vendor platforms. Next layer is broker to NSE lease line. So broker has finally placed the order. It has sent it to the exchange. So it goes through a lease line. There is some latency there, some delay there. Next, NSE performs its own validation checks. There is some delay. Then exchange keeps your order in a queue and based on price time priority, your order is matched. That is best price order is first taken. After that, order which came early, right? Many orders might have the same price. So within those orders, time is checked and based on these, the orders is matched. So where will your order actually be in the queue is completely random based on several things. That is why slippage cannot be accurately determined. Then there is HFT collocation repricing. What this means is when you see this order and place a buy order, by the time your order is executed, what HFTs could actually do is they could actually increase the offer price in that few milliseconds because they are directly co-located in the exchange and they have access to the order flow books. They could actually reprice their orders. When they see that there is a lot of buying aggression by option buyers, they could actually keep the offer price much higher. They could reprice quickly than your orders get executed. This is a more advanced concept. I've just kept it as a layer so that you know that these kind of things do happen. Then there is order book walking. For example, let's say you want to buy this option. The best price that you're going to get right now is 137.5 6. And how much quantity? Only 520 quantity. Let's say you want to buy 1000 quantity. So you are going to get 137.6 for the first 520 and then 137.65 for the rest of the quantity. That is called order book walking. Finally, there is confirmation delay. So after the order is executed, exchange also executes the order. Now exchange sends confirmation back to the broker and broker has to send it back to you. There is a delay there. Let's assume that based on the first order, you are going to trigger another order. Then your second order's execution will be based on how quickly you get the confirmation of the first order. So if you have a strategy which is based on sequential orders, let's say first this is going to be the first buy order. After this executed, then I need to do another order. Let's say there is a sequential play. Then in those cases, you are going to have more slippage. Now here is the options trading cost simulator which is available in our website. Using this, you can actually understand the effect of slippage with respect to your strategies. Let's say you have a capital of 5 lakhs, very good capital for trading. Profitable days 100%. Let's assume that you are profitable on all days. So 250 winning days in a year. And the risk that you take per day is 5,000. That is 1% of 5 lakh. Risk to reward is 1 is to 1. I put daily risk to reward 1 is to 1. So on winning days, you're going to make 5,000 and all are winning days only. But let us assume that to achieve this particular outcome, you are using 20 trades per day. Overall, the strategy has positive expectancy, but you are taking 20 trades per day to achieve this particular expectancy. And the premiums that you are dealing with is when you are buying, you are dealing with 100 rupees or a similar premium, selling 100 rupees or similar premium, quantity, let's say 200. Let us assume that the beta spread for these premiums are about 0.25% and slippage is about 0.5%, very conservative numbers. So you have a strategy which wins on all days. I put very conservative beta spread and slippage percentage, and you are making a profit. Look at the gross profit on the right hand side. For this strategy, the gross profit is 12 lakh 50,000. On a capital of 5 lakh, you're making 12 lakh 50,000. But because you're taking more trades in a day, and because there is beta spread and slippage in every trade, your cost will actually balloon to 19 lakh 23,087. Now, what is the split of this cost? Brokerage and other costs 4,23,000. Bidder spread cost 5 lakhs. Slippage cost is 10 lakhs. Even though you have a great strategy, you are going to end up in a loss because of bidder spread, slippage, and cost. Now, many traders do not assume this bidder spread to be a separate cost. They might consider it to be slippage, but I identify them separately because bidder spread is always known for the instrument you are trading. So look at this 22,800 call option, ATM option. Bidder spread is 30 paisa, 137.6 minus 137.3. It is always known for the instrument that you are trading in. Even if not directly, you at least know the range. But slippage is actually not known because our order goes through these many different layers. We are not sure what price we will get. Sometimes you execute order at 100, it gets executed only at 105. That could also be the case. 5% slippage is a reality. That is why I always consider bidder spread and slippage to be separate costs, brokerage and taxes and other charges to be separate. We have come to the final slide of this session. Now, how do we handle this slippage? First of all, you have to cap the number of intraday trades to 6 trades or less. The moment you take that 7th trade, every trade is 1 buy order and 1 sell order, so 12 orders in total. The moment the number of orders moves more than 12, most of the strategies end up in a loss. So this is the first thing that you need to remember. Second is completely avoid scalping and high frequency trading. They are absolutely not profitable. At a gross level, they might be profitable. So this is some scalping type of strategy. At a gross level, it is profitable, but at a structural level, it gives you a loss. When you consider bidder spread, when you consider slippage, when you consider brokerage, it will give you a loss. Completely avoid these. Third, avoid options premium less than 40 rupees because there the bidder spread and slippage as a percentage is very high. It could even go to 2 to 3%, and the trades are absolutely not going to end in your favor. Finally, track every fill, track every order. What was the expected price of execution and what was the actual price that you got? It will help you understand more about how well your systems are executing, how well your algo platform is executing, and how well your broker is executing. Now, these are very important things when you have aspirations to do shorter term trading. If you have capital of just 1 to 2 lakhs and you are trying to do scalping, that's a dangerous combination. That's the fastest way to lose money. So when you have low capital, avoid trading. When you're trying to overtrade, when you think that 40 trades, 50 trades are going to make me end up in profits, that's not true. You're actually going to end up donating money to market makers, HFTs, and other smarter players. So that's all in this session. I'll see you in another video soon. Thank you for watching.